Excluded property trusts. How on earth does that help you protect your Hong Kong assets, or any other foreign assets for that matter, from UK HMRC inheritance tax? Check out this video as Chenji and I go through those details. For anyone that is going to be moving from Hong Kong to the UK, there is this period of time, which is 15 years, where you become domiciled. And people living in Hong Kong, when they hear me talk about inheritance tax, will look at me blank, because you don't have that in Hong Kong. But when you die in the UK, and you as an individual have assets more than £325,000. And when I talk about assets, I talk about net assets. So from E's point, looking at a property that you own, like a home, that's value of £500,000, mortgage £100,000, means the net asset value is £400,000. Well, on your death, the excess of 325,000, 75,000 in this example, would be subject to 40%. That's right, 40% in tax. So as Chenji joked before, is make sure that you update your will to include Uncle HMRC into your will writing skills, because that's what technically you might be able to do. But the big thing is when people move from Hong Kong and they've got significant assets, and the big question is, well, do I bring them to the UK? And I often say to them is, well, you have to be a bit careful of dying in the UK, because your assets in the UK will be subject to this inheritance tax. But you have this period of time of 15 years whereby your worldwide assets would not be subject to inheritance tax. So you might want to leave assets offshore for that purpose. But Chenji and I discussed something that was even more sophisticated, but I think easy to explain on this show, Chenji, about the property excluded trust, which, let's bring this to an example, but someone's got assets in the UK of £100,000. It's not subject to UK inheritance tax. But let's say you've got £10 million worth of estate value in Hong Kong, that would be subject to inheritance tax after 15 years in the UK. So how does someone like that protect those assets, Chenji?
Oh,
Chenji's on mute as well. Chenji, we're all doing it.
We're all doing this today. No, thank you, Simon. We are indeed, actually, this is a very complex subject with a lot of legal, tax, and also financial advice related. So kind of like to sort of, hopefully I can make it easy for everyone. But if there are any questions, please do put it in the chat box, and, I'll try to answer that as a follow-up as well. I think, first of all, when I came to this country and I learned about inheritance tax, I was very taken, because I thought in the beginning, inheritance tax will only be applied for all of the assets that you have in the UK. But as Simon Mishowitz has said, no, indeed, you have to pay on all of your worldwide assets. So if I have assets in the US, which I currently do have, and after living here for 15 years, then I have to bring my US assets into my net asset calculation, which might put me up that threshold, and I will have to pay 40% tax on the amount above 325,000. Now, there is one aspect of planning that we can do, and we do this extensively for some of our clients who have significant assets abroad. It's called excluded property trust. So before you stay in the UK for 15 years, so remember this number, 15 years, it's very important, because that's, again, if you stay here for 15 years, you will become what's called a UK deemed domicile. You don't have to be a UK citizen, and you might not even have to be a UK resident to become UK domicile. But once you do, it means you are subject to inheritance tax on your worldwide income. Now, before this happens, when you can set up an excluded property trust, an HMRC, which is the Inland Revenue in the UK, they will say, okay, you were not a UK domicile in the first 15 years. and all of your assets actually don't belong to you, and they are not in the UK. So this is what the trust is about. This trust will own your properties. It can be properties, it can be stocks and shares, it can be cash as well. They cannot be in the UK, they have to be offshore, usually, somewhere in Jersey, Guernsey, and Ireland. And you have to do this while you are not a deemed UK domicile, right? And effectively, you are giving up control of this to the trust. And, without going into more details about how trusts work, but, you can be a beneficiary of that trust, which means if, for example, you have a rental property in Hong Kong that you don't wish to bring to the UK and you are still receiving income from it, you can transfer that property into the trust, and you will still continue to benefit from the income that the property provides you via the trust. It is essentially just a structure for you to keep your assets outside of the UK. Again, this is a very sophisticated part of planning, which involves solicitors, which involves tax advisors, and involves a financial advisor too. So if you do have any questions, please do follow up with the panel members and myself here. So yeah, I hope I've relatively explained this in an easier way, but there's no simple way to really touch this subject on.
There are many live events that you can register for free. There are 4 events that's showing HK to UK to help people move from Hong Kong to the UK. The Property Expert Panel. If you're a property investor and property developer, this will be very useful for you. Tax Q&A. If you want to ask proactive tax questions in regards to structures and how to mitigate tax in the future. And finally, UK tax return Q&A, as it says, to deal with questions in relation to your tax returns before you submit it to HMRC. Don't forget that these events are live and will be shown on YouTube the day after. So why not register today, start saving tax tomorrow?